Okay, so we're gonna do an example here for Chapter 2 and Appendix A. So Chapter 2 teaches us the integrated financial statement framework, and Appendix A teaches us dual entry accounting, which is what most accountants use. So I'm gonna go through Chapter 2, Problem 2-1, and record all of these transactions in both formats. Okay, so we're starting on page 72, problem 2-1. In this case, I'm not going to read the instructions because we're just going to use that data for our own purposes. So let's just record these transactions in an integrated financial statement. So let's start with, we have A through I. Okay, so there are our transaction numbers, and I'm gonna want some check figures. Okay, so first thing is probably beneficial in an integrated financial statement to get kind of an idea of what you're working with so that we can build our balance sheet across the top. So I'm gonna do that first. So our first transaction is we open a bank account with an exchange for capital stock. So we're gonna have cash, we're gonna have stock. The second one, we borrowed 30,000. So now we have a note payable. Third one, we received cash from fees earned. Now, fees earned don't go on our balance sheet. That's an income statement item. So let's just move over here and say income statement. And we have fees. Paid rent on office and equipment for the month. So again, paying rent is an expense. So that goes on our income statement. Paid automobile expense and miscellaneous expense. So auto and miscellaneous, again, expenses belong on the income statement. Paid office salaries. So salaries are an expense. Paid interest on the note payable. Interest is also an expense. Purchased land as a future building site. Okay, now land does not belong on our income statement. That's an asset, so we need to add asset here. And we paid dividends of 2,000, and so dividends are gonna go into retained earnings. Okay, now I have that set up. That should make it a little bit easier to work with. Before I get started typing numbers in, I'm just gonna make all these, add commas to all these to make it easier for us to read. Okay, so A, opened a business bank account in the name of Woods Insurance with a deposit of 40,000 in exchange for capital stock. Okay, so if we open a bank account with a deposit of $40,000, we have increased our cash in the business. And I swear I got rid of those. Okay, so 40,000 in exchange for capital stock. So in our integrated financial statement, this is what it looks like. Now in our double entry accounting system, it's going to look like this. We have a deposit of cash, so we increased cash. And if you look at your debit credit helper, you'll see that an increase to cash is a debit. So we're going to, let's do debit credit. Okay, and then, well, let's keep them the same. Okay, so if we debited cash for 40,000, our credit has to also be for 40,000. And of course, that's going to be stock. Let me just put commas in this part. Okay. So in this transaction, let's sum these up actually. Okay, so we are left with 40,000 here, 40,000 here. So our debits match our credits, which in dual entry accounting is a good thing. Should always add up to 0. Okay, so B, borrowed 30,000 by issuing a note payable. So when we borrowed 30,000, we increased our cash. We issued a note payable, so we also increased our liabilities. Oh, that's the other thing I was going to do, is I was going to make sure we balance up here as well. So remember, our assets should equal our liabilities plus our equity. So we want our assets, cash and land, minus our note payable, stock, and retained earnings. We want that to equal 0 after every transaction. Okay, so looks like we're okay. And actually, I'm going to do something just for fun here. This is called conditional formatting. This is kind of a cool trick to help point out errors. So this number should be 0, and this number should be 0. So I'm going to highlight both of those. Go up here to Format, and I'm going to do conditional formatting. So this conditional formatting is applying to these two cells I have highlighted, H4 and G17. And my rule is if it is not equal to. Okay, so those cells are supposed to be 0. If they're not equal to 0, I want to highlight them kind of a reddish color. Okay, so now we have this conditional format. I'm going to close that just to show you what that does. If I delete that, it highlights it for us whenever we're out of balance. Okay, cool. So B. Okay, integrated financial statement. This is how we record it. In dual entry accounting, we are going to record it by, we received 30,000 in cash. Cash is an asset, which increases with a debit. We're going to put cash here for 30,000. And we took out a note payable. A note payable is a liability, and it increases with a credit. So this is going to be a credit. We're back to balanced again. I'm going to hide those. Okay. Letter C, received cash from fees earned. Okay, so we got cash again. And in this case, it's from fees earned. Now, fees earned do not go on our balance sheet. Fees earned go on our income statement. Okay, so we're going to put our fees right there. And you'll notice we're off by 28,000. And that's because we don't have any retained earnings in here yet. So I'm going to put retained earnings just down here at the bottom. Okay, and remember, our retained earnings comes from our net income. So I'm just going to do that. And then our net income is our revenue, which is fees, minus our expenses, which are all these that we've listed below, 28,000, and oh, it doesn't work because that ought to be there. Okay, there we go. Okay, now as we build our income statement, I don't know what the deal is with that. I swear I'm hiding the decimal places and it's not working. Okay, so now we're back, we're golden, we're not out of balance again. So let's record this in a dual entry accounting system now. So we received cash from fees. Again, we're increasing our cash. Cash increases with a debit. And we got it from fees. So fees go into retained earnings, and retained earnings increases with a credit. Okay, so we're balanced again. Let's go up to D. We paid rent on office and equipment for the month of $3,000. So if we paid rent, we lost cash. So we wrote somebody a check. So we're going to decrease our cash by $3,000. And we're going to put $3,000 in our rent here. Okay, so our integrated statement works out just fine. And if we come down here, let's see, we paid rent on office. So we paid cash. Cash is an asset. So, and we decreased it. Cash decreases with a credit. So we're going to put a credit for cash. And paid rent. Okay, so rent is an income statement item, which means that it flows to retained earnings, and retained earnings increases with a debit, increases with the credit, and decreases with a debit. So we are going to debit rent for $3,000, and voila, we're balanced again. Okay, paid automobile expense for the month and miscellaneous expense. So we decreased our cash again. I'm going to put these both on one line, minus 900. And over here, they'll be on two lines. So auto is 1,800, miscellaneous is 900. Okay, so again, we're balanced up here. Now, let's see. We paid auto. Auto flows through to retained earnings, and retained earnings decreases with a debit. So we're going to debit that for 1,800. We also paid miscellaneous. Again, it's on the income statement, which flows to retained earnings, and a debit will decrease retained earnings. So we're going to decrease by the 900 we paid for that. And then again, we paid with cash. So cash, and cool, we're balanced again. Now, one thing I will point out here is you kind of have to pay attention in the book. These transactions don't say what we paid with. And so if it doesn't tell you what was paid with, then you always assume that it was paid with cash. Sometimes it will say paid rent with note payable. But if it doesn't mention what you're paying with, you can always assume that you're paying with cash. Okay, just a good thing to keep in mind. So paid office salaries of 4,200. Again, if we pay salaries, we're going to decrease our cash. Salaries are not a balance sheet item. So they're on our income statement, which is going to flow through to our retained earnings statement. And we're balanced again. Okay, so we can come down here to F. And F is going to be, let's see here, we paid salaries. So we increased salary expense. and an increase to an expense decreases our retained earnings. The debit, and we paid with cash again because it doesn't say otherwise. So we are once again balanced. G, paid interest on note payable. Okay, so this is one where I imagine some of you will get messed up, but what we did was we paid interest. Okay, so if we're paying something and it doesn't tell us otherwise, then we're assuming it's with cash. So we spent $100 in cash, and interest is $100. Whoops. Now, notice it's mentioning note payable, but it didn't actually affect the note payable because we didn't pay off any of that $30,000. We just paid the interest that had accrued from that $30,000. So be careful with statements like that because they're kind of designed to trick you. Okay, so again, we have an increase to interest expense. Expenses increase with a debit, flow through to retained earnings, and decrease retained earnings with a debit. So we have a $100 debit to interest, and we spent cash, so we have a $100 credit to cash, decreases our cash balance. H, purchased land as a future building site. Okay, so we purchased land, and again, it doesn't tell us what we purchased with, so we assume it was with cash. So we're going to spend cash of $55,000. Now, land is an asset, so we're going to increase our assets by $55,000. And notice that only affected this one side of the balance sheet. It only affected the asset side. An increase to cash, or a decrease to cash and an increase to land. So we're balanced still. So let's come down here, and we had an increase to our land account, which is an asset. Assets increase with a debit. And we had a decrease to our cash account. Cash is an asset, so it decreases with a credit. And again, we're balanced on both sides. I'm going to do this so that we know that those are ones we got to pay attention to. Okay, paid dividends. So again, we paid for something, didn't tell us how we paid for it, so we assume that it's cash. Now, dividends, these are another one that's kind of confusing. A lot of times people will make the mistake of assuming a dividend comes out of the income statement. But a dividend doesn't get paid unless you have income, generally. So a dividend always comes out of your retained earnings balance, not from your income statement. Again, your income statement affects your retained earnings, but your dividends come directly from retained earnings. They're not a pass-through from your income statement. Okay, so we decreased cash, and by paying that out, we also decreased our retained earnings. Okay, so if we record this last one, we're going to have, we'll call this dividends. And dividends are a component of retained earnings. And so when we pay a dividend, it increases the dividend payment with the debit and decreases retained earnings with the debit. Okay, so we put 2,000 and we're going to say cash. And again, we decreased cash, so that'll be a credit. And okay, our integrated financial statements are actually built now. So this is our balance sheet, and it looks kind of funny, but what it ends up as, and I'll just type it over here, is we have a cash balance of $31,000. We have land of $55,000. We have a note payable of $30,000. We have stock of $40,000. And we have retained earnings, $16,000. And so our total liabilities and equity is $86,000. And our total assets is also $86,000. Okay. And as we went through that, we built our income statement. So we have 2 of our 3 financial statements done. In this case, our statement of retained earnings will also be pulled from this and this. So we would have a beginning balance of 0 because we didn't start with anything. We had an increase of $18,000, a decrease of $2,000. So our change to retained earnings would be $16,000. So the integrated financial statement framework basically allows you to build your financial statements as you go. With our dual entry accounting, we still have to do that with this. Okay, so we'd have to go through this and say, okay, we have a debit to cash, a debit to cash, a debit to cash. So we have 98,000 in debits, and we have 67,000 in credits. So we have a $31,000 increase to cash. So we would put cash at 31,000. Anyway, that's the benefit of using this integrated financial statement framework. I actually don't think it's better, but where we have 1 semester to learn accounting and analysis, I think this is the quickest way to teach you how to do both. So hopefully this will help you in your homework this week. And again, feel free to reach out with any questions that you have, and have a good week.